It's a panic alert. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, this just crashed by 57%, and I want you to understand why I'm terrified, because the political elites and the central elites continue to tell us that we're headed into a soft landing or no landing scenario, and based on the data we just got, it indicates that the global economy is headed into a recession, and the U.S. is right behind it with everyone else. This is going to be absolutely devastating. But one company we think is going to continue to boom due to their game-changing technology no matter what the economic conditions are, and that is the stock for our sponsor of today's show, Hillcrest Energy. You can find them on the CSE under the symbol HEAT and on the OTCQB under the symbol HLRTF. And demand for Hillcrest is booming. It's surging all the way into 2025, as I'll show you. And from a stock perspective, after a massive rally, the sellers came in and have driven the price right back into a prior supply zone where the buyers have been sitting at. And with the sellers flushed out, I'm going to show you a setup that could realize a 34% return. You don't want to miss out on this one. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Bloomberg, where he picked today's story up with a headline as slumping freight rates telegraph warning on Asian crude demand. And energy is absolutely critical, because in a global economy, when you see demand for energy rising, it means the economy is booming with it. And all of a sudden, we're seeing major problems in the energy market and in the shipping market. And this is a huge red flag that's pointing to a deep and protracted global recession. Freight rates for very large crude carrier from the U.S. to the key Asian markets tumbled more than 20% since late May, while earnings on the benchmark Middle East to China route sank a whopping 57% in the same period. Each vessel can haul cargo totaling about 2 million barrels, and this softening comes as demand for VLCCs has fallen in recent weeks, with an industry gauge known as ton miles dropping sharply. So out of nowhere, we start to see that the U.S. consumer started struggling last month, and now all of a sudden the energy sector is starting to face issues. This is why we've seen energy stocks head lower despite crude prices rallying, but look for crude now to make a major reversal, because this is the indicator that we're seeing global recession starting in Asia, and we're not far behind here in the U.S., as you're about to see. As cheaper shipping costs for the world's most important commodity pose a challenge for tanker operators, who's already been forced this year to deal with the fallout from Houthi attacks on vessels in the Red Sea that forced substantial rerouting and a surge in congestion at some key Asian ports. But the drop may also be a significant signal for the crude market, given that it flags softer consumption in China, the world's largest oil importer. And of course, if China is having problems, which we know their economy is, but they continue to give us the indication it's getting better, that the energy market's telling us it's getting worse, because if the world's largest exporter is having problems, well, it means the world's largest importer is seeing demand fall as well. That means China is likely now to be the first country heading into recession. We'll get some more key data on them later this week, but I'm going to make the case of why the U.S. is a lot closer to being in a recession than even many of the experts think. As oil edges lower, as focus turns from hurricane to the Federal Reserve, but one thing that's likely to head higher, that is the stock for our sponsor of today's show, Hillcrest Energy. Again, on the CSE under symbol HEAT and on the OTCQB under symbol HLRTF. And on some news, which we'll look back at, we saw their stock just rally, and then the sellers came in and pushed it right back down to the supply zone. And what this indicates is that when sellers are exhausted, as we can see, this was a prior zone of buying support. What it's setting up now is a move 34% higher into the supply zone. You don't want to miss out. Stay tuned to the end of the show for more information, as forecasts for higher fuel consumption throughout the northern hemisphere summer have been supportive of prices. Those slumping super tanker earnings are a reminder of ongoing concerns about Chinese consumption. And there's this hope that there was going to be so much demand from the North American consumer for energy that it was going to drive prices higher. The problem is we're starting to see indications that perhaps the U.S. consumer isn't as strong an ability to absorb these higher prices over the next coming weeks. Of course, the Department of Energy will continue to report their weekly data. This will be critical if we can start to see builds in gasoline and distillates. Watch out, the energy market's going to come unwound. As clues on the state of the market will come on Tuesday. Of course, this is the short-term energy outlook today. We'll get the official EIA inventory data later this week. But I want you to see the effects of energy prices, particularly higher energy prices on consumers at a time when financial conditions for most households are very, very tight, meaning they don't have a lot of extra money to spend. And so when our energy prices, how do they impact a consumer's budget, is very simple. It leads to less discretionary spending. And that, of course, means inflation comes down and more people head to the unemployment line. And we can look back into the early 2000s, heading into the dot-com bubble. You can see that consumer prices were relatively high, and gas prices here continue to push up a little bit, that all of a sudden the consumer couldn't afford them. Inflation came down, energy prices came down as well. You see that effect here between 2012 and 2014. Consumer prices were continuing to slow down. Meanwhile, energy prices, the market believed the consumer could afford it, and in the end of the day, they couldn't. We see inflation and energy prices come crumbling down. And you see that same effect right now between 2012 and 2014, where the market is continuously bullish that the economy is about to boom in the second half here, and they want to drive energy prices up. And what it does is break the back of household spending in a big way. And you can just see that consumers just do not have the ability to absorb higher energy prices. We can look at total compensation growth, shown as average hourly earnings multiplied by average weekly hours of production in non-supervisory employees. This showed in blue on a year-over-year rate of change against gas prices. So you can note what happens is as total compensation decelerates, as you see the blue line heading lower against rising energy prices. Well, what that suggests is demand for energy is about to plummet. And we're seeing that here in China, and that's going to flow to the U.S. in not too long, because we see that happen again in 2014 through 2015. Again, payrolls went down, energy prices came with it. This time, every increase in gasoline prices gets rejected because consumers just do not have the spending power. And that means, of course, anything that reduces the consumer's ability to consume in terms of the discretionary side of the economy, which higher energy prices do, well, that puts us squarely into a recession, because it means less demand, less need for labor, and it all starts to come unwound. And if we see further evidence that stocks remain higher, despite the fact that they don't see a recession coming, this after Jerome Powell's remarks today in front of the Senate. But look at this, risk-taking traders are keeping a close eye on a heuristic recession indicator known as the SOM roll, which we talked about in the show last week after the recent jobs data. And this is real key. Again, we look at the energy market here because the SOM roll has a very key indicator in terms of the labor market. It says when it breaks above this dotted green line here, well, watch out. It means the labor market's going to come unwound. And you can see the effects of the energy market. Looking at gasoline prices rising into a period where unemployment claims start to reach a level that it's just too much for the economy. And next thing you know, it breaks out and energy prices come tumbling down. And we see that effect happening now, that the energy market remains bullish on the consumer, and the consumer is saying, look, I just don't have the money to spend here. As demand goes, jobs go, and so too does the U.S. economy that many people do not believe is going to experience a recession. But what we're seeing in the crude oil inventory markets now and in the shipping markets is telling us we're far closer to a recession than even the experts think. And the rule was conceived a few years ago in 2019, according to this is the SOM rule, that is, but has accurately indicated the start of recession since the 1970s. And with the U.S. stocks hovering near all-time highs and traders eyeing rate cuts this year, the prospects of a recession has tapered off as hopes for a soft landing mount, which is why, of course, you see equity markets grind higher. But signs of cracks in the labor market could challenge that confidence, forcing traders to reconsider their positions, and yes, they will have no choice. Because here you can see again, looking at the effects of higher energy prices on an economy that can't handle it, we now look at continued unemployment claims. And you can see here again, going into the dot-com bubble, energy prices continue to rise and remain elevated. It was just too much for the economy. It tapped out too much discretionary spending and sent people onto the unemployment line, where they managed to stay, and then more and more people joined them. You see that happening during the global financial crisis. You even see it heading early into the pandemic, where high gasoline prices put an end to the bull market, in the labor market, that is. And now you see the effect again. Every time we get an increase in gas prices, well, more and more people end up on the unemployment line, and even worse, they get stuck there. And here's the evidence that indeed the U.S. economy is heading into recession as consumers slow down spreads, as Helen of Troy shares crash after big earnings miss and earnings per share outlook cut. Consumer products company Helen of Troy crashed in pre-market trading in New York after missing expectations and slashing its full-year outlook. This is yet another warning of lingering inflation and high interest rates impacting consumer spending. We can add high gas prices as well, because that is the biggest factor that consumers deal with on a weekly basis. And we're disappointed with the start of the fiscal year. We battled an unusual number of internal, external challenges in this quarter, which resulted in net sales and adjusted EPS below our outlook. This according to the CEO. Many of these challenges became more pronounced toward the end of the first quarter, and some continue to evolve. And Helen of Troy designs, develops, and markets branded housewares, health and home products, and beauty products worldwide, many of them you know of. And the company reported big fiscal first quarter earnings miss, coming at 99 cents a share on revenue of $416.8 million. But look at this: home and outdoor net sales revenue down 8.6% year over year. Beauty and wellness net sales down 15% year over year. And these quarterly sales misses are, the company's saying at least, have softer consumer demand written all over it and shifts in consumer spending, which means consumers have less money to spend, and they're focused on what they need to get by day to day and not the discretionary side of the economy. But meanwhile, you see, of course, 5 companies driving the equity market higher. And here you can see against the S&P 500 in blue, you see the S&P 500 Consumer Durables and Apparel Industry Group in black. And if you look at this relationship, what it suggests is the S&P should likely be trading much closer to 3,000 than its current level of 5,500. If you can imagine how devastating that would be to the U.S. economy. But it's very clear that parts of the U.S. economy are indicating that things are flashing a danger sign. And what this means, of course, is we're much closer to a recession than not. And we can even see that consumer borrowing rises the most in 3 months, and it had virtually no impact. And why is that? Because consumers are strapped and they're charging what they can, why they still can get away with it. Total credit outstanding rose $11.4 billion after a revised $6.5 billion gain in April. The median forecast called for an $8.9 billion increase, suggesting consumers were charging in a big way. But the question is, were they charging things like gasoline because they couldn't absorb the higher prices, or were they outspending in the discretionary side of the economy? Well, the evidence from Helen of Troy is they're not spending on the discretionary side. They're tapped out and relying on their credit cards, because there's one big factor here is they're out of money. And revolving credit, which includes credit cards, advanced $7 billion, also the most in 3 months. Non-revolving credit, such as loans for vehicle purchases, school tuition, increased $4.3 billion. And many Americans who have whittled away their pent-up savings accumulated during the pandemic are now relying on credit cards and other payment methods to spend. Combined with a rise in the cost of living that's further straining household finances, points to a slowdown in consumption, particularly since total household income is not keeping up with inflation. And of course, you tack on debt service costs at these ridiculously high interest rates, and it's a perfect storm of why just a little increase in energy prices is all the U.S. economy needs to tip it into a recession. And that may explain a recent pullback in consumer spending. And well, it sure does, as retail sales barely rose in May and prior months were revised down. That is for sure, because you look at the case here of higher energy prices, still showing gasoline prices in red, now against advanced retail sales in blue. That's shown on a year-over-year rate of change. And you can see when consumers get tapped out as higher energy prices cause a deceleration in retail sales. In the global financial crisis has led to an all-out contraction. Even around 2014, 2016, you can see that effects of, again, higher energy prices led to a decrease in consumer spending. Happened again in 2018, and it's happening again now. Every attempt by the market to drive energy prices up is met by less and less consumer spending, making it very clear that we are headed into a recession. And the Fed's report on Monday showed that borrowing rates on credit cards that charge interest rose to a whopping 22.76% in May, just shy of a record data set back in 1994. A 60-month loan from a commercial bank for a new vehicle purchase stood at 8.2%, near a series high. And as of March, 3.2% of outstanding debt was in some stage of delinquency, that according to the New York Fed. And while it's lower than the fourth quarter of 2019, delinquency transition rates increase for all product types. And this is what happens as consumers run out of money. They use all their available credit, and the next thing you know, the music stops, the delinquency rates start to rise, and it's game over for the U.S. economy. And that's why we see this plunging demand in the energy sector being a very critical indicator of why the U.S. economy and global economy are about to head into recession. But one company that has some game-changing technology that's seeing outpaced demand, that is Hillcrest Energy, our sponsor for today's show. Again, you can find them on the CSE under symbol HEAT and on the OTC QB under symbol HLRTF. Let's take a look at what's going on. We're going to go back to their prior press release that really drove their stock up, and I'm going to show you what's coming right now as Hillcrest partners with Ocean Batteries to deploy a ZVS inverter and grid-connected energy storage systems. And this, again, sent their stock rallying in a big way, as Hillcrest will work with Norway-based Ocean Batteries on the design and testing of a ZVS inverter for integration into their onshore energy storage systems, or ESS, and completion of a definitive supply agreement. Ocean Batteries is already delivering the highest efficiency and most dependable marine electrification system to their customers, and now they're looking to expand their offering to include next generation ultra efficient onshore ESS solutions. And of course, this is huge because it's expected to have a compounded annual growth rate exceeding 18% through 2029. And now we see demand for Hillcrest Technologies is booming as books 2024 demonstration slots amid surging interest in their ZVS inverter. And this is huge because the demand from potential customers in both electric vehicles and stationary applications is accelerating as we continue to adapt to customer feedback, improve our technology, and generate even more impressive test results. This from the CEO, Don Curry. Between the burgeoning pipeline of demonstration requests and our product development efforts with partners like Ocean Batteries and several European automotive manufacturers, we're approaching full capacity this year. New customer demonstrations not already in our pipeline are being scheduled into early 2025, a very positive indicator of expanding interest in our technology. And their inverters utilizing proprietary zero voltage technology offer superior electromagnetic compatibility and industry-leading efficiency up to 99.7%. These combined benefits translate into expected cost savings of up to $2,200 per vehicle in EV traction applications. In stationary grid connection application, Hillcrest ZVS inverter provides exceptional efficiency and enhances power quality, especially in applications such as energy storage, where frequent bidirectional charge and discharge cycles magnify the benefits. And when we first presented our ZVS inverter technology to EV manufacturers, we highlighted its exceptional efficiency and overall improvements it could bring to powertrain systems. We since realized that manufacturers also place high value on vast improvement ZVS offers in EMC, and currently EV many manufacturers incur substantial costs and that extra weight to mitigate the negative impacts of EMC. The ZVS technology can greatly reduce or even eliminate those costs, and by combining these EMC benefits with our efficiency gains, we can revolutionize the future of electric vehicles, and that could revolutionize your brokerage account as well. As you see here on that original press release, it drove the stock up, and what happened then is sellers came in and sold down. You'll see these horizontal purple lines indicating supply zones, and this one right here is where the buyers have been at, accumulating shares for many, many months, and this drove, of course, on that news, the price higher. Sellers came in, and you'll notice it's finding support right back where the buyers are at, indicating that the sellers may be completely exhausted here. When that happens, it sets up the next move higher, which would be a 34% gain right into the volume profile at 29 cents a share into that prior upward supply zone. As you can see, as we zoom into the 30-day chart, it's very clear that buyers are coming right underneath here over the last several trading days, putting a floor in the price, and again, setting up a move higher for Hillcrest Energy. Again, you can find them on the CSE under symbol HEAT and on the OTCQB under symbol HLRTF. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.